Hello students, welcome to BYJU'S. In the recently concluded budget, the Finance Minister has announced that Government of India will be issuing Indian sovereign bonds and will be borrowing $10 billion from the foreign market. So in this particular session on Explain, let's try and understand what is this concept of Indian sovereign bonds. But before understanding the concept of a sovereign bond, what are the basic concepts associated with the government borrowing? Now please understand, government will issue certain types of securities in the domestic market. And these particular securities are usually referred to as debt securities or bonds. In simple terms, these will have a feature of interest rate, but rather than calling interest rate, they will call coupon rate. And there is maturity period associated with it and guaranteed payment. So government will issue these kind of securities in the domestic market, wherein the domestic investors as well as foreign investors are allowed to invest. In simple terms, they can purchase these particular securities. But more importantly, understand this, how much is the value of the investment done by the foreign investor? It will be limited by the government. There are certain restrictions imposed by the government on these particular investments in the G securities done by the foreign investor. More importantly, these particular securities are issued in the form of rupee denominated securities. In simple terms, when government issues the securities, they will collect money in the form of rupees. When government repays the money, it will be paid in the form of rupees. What is the inference? Inference is whenever a foreign investor invests in these particular securities, the exchange rate risk is borne by the foreign investor himself. Simple terms, if the exchange rate varies, the earnings of the foreign investors will also vary. For example, when he invested in these particular securities, let's say the exchange rate was like this, but when he is earning, rupee has depreciated. Now if he wants to take out this particular money from India, he has to pay higher rupees to purchase the same amount of a dollar. His earnings will get hit. So in simple terms, whenever Government of India issued these particular securities in the domestic market, the exchange rate risk was borne by the foreign investor himself. Now, apart from these particular borrowings, which was done by Government of India in the domestic market, government also borrowed from foreign institutions such as World Bank. So in simple terms, this particular borrowing done by Government of India becomes internal borrowing, and this borrowing becomes external borrowing. Usually these particular borrowings are given as a percentage of GDP. In case of India, the external borrowing comprises of only 5% of GDP. And in case of India, historically, we have ensured that these particular borrowings are usually given or represented in the form of percentage of GDP. In case of India, the sovereign borrowing in the form of external borrowings has been in the range of 5% of GDP, which is considered to be a good feature for any of the economy. For a simple reason, if the external borrowing is very high and if there is any depreciation in the domestic currency market, then the liabilities will keep on increasing on the head of the government. So historically, in case of India, so as to ensure that this volatility in the currency market will not affect the debt market of the government, we have ensured that this particular external debt will be on a lower level. And so is the feature with many of the Asian economies. Now, once you have understood this particular concept of a government borrowing, what is Government of India proposing? Government of India is now saying, just like the securities or the government securities which they are issuing in the rupee form in the domestic market, they will start issuing the government securities or the bonds in the foreign market also. But more importantly, these particular bonds will be denominated in foreign currency. What is the meaning of this? Government of India, if it issues this kind of a bond in US market, it will sell the bond and it will take the money in the form of dollar. It will repay in the form of dollar when this is done in case of the US market. Hence, this is a concept of the sovereign bond which the government of India has proposed. Now, what are the reasons? Why is government of India opting for these kind of bonds? Simple reasons are: one, the expenditure requirement is increasing. In simple terms, the investment should increase. There is a need of huge investment in the domestic market, but the issue is the government of India has borrowed heavily from the domestic market. More than 85% of the savings which are present in the domestic market is cornered by government of India. Now, whenever this happens, understand this, whenever government of India borrows heavily from the domestic market, the demand for money in the domestic market will increase. For a simple reason, more people are borrowing. And when the demand for money increases, the interest rates will also tend to increase. Now imagine here is a private sector, here is a government. Both of them started demanding money, but government of India increases its demand for money, interest rates will increase. This will negatively affect the private sector. And when this kind of a interest rate increase happens because of a higher government borrowings, these private sectors usually tend to start searching for borrowings from other markets. For example, external commercial borrowing. And whenever the private sector will move away from this market to another market for the purpose of borrowing, we call this as crowding out effect. So understand this. One, government of India has borrowed heavily from the domestic market. And second, investment demands are rising. If government of India further increases its borrowing, it might lead to crowding out effect. And third, the bond market in the domestic area, that is in case of Indian economy, is not very well mature compared to Western economies. These are some of the reasons which has been stated by government of India as to why they are opting for issuing these particular sovereign bonds. What are the benefits they are expecting? One, they will reduce the crowding out effect. Rather than crowding out, what will happen? The demand from the government side for the money in the domestic market will come down. Interest rates are expected to come down, and when the interest rates will come down, the private sector will start borrowing from the domestic market itself. This will lead to crowding in. That is one benefit. Second, the interest rates in the international market are comparatively lesser. I'll repeat the statement. The interest rates on the loans that will be taken from the international market, that is basically when they issue the bonds, they will guarantee certain coupon rate, which is nothing but the interest rate. So the interest rate on these particular instruments in the international market is much lesser than what it is in the domestic market. It is said that government of India will be able to save the interest rates in the range of around 200 basis points to 300 basis points. This is a second advantage of the benefit. Third, it will lead to integration of Indian financial market with the global financial market. Fourth, if there is a very high demand for these particular Indian sovereign bonds in the foreign market, it basically means that globally, the viewpoint related to Indian economy is very positive. That is a very good outcome. Fifth, if India lists its bonds in the foreign market and gives a certain coupon rate, then this particular interest rate or coupon rate might become a benchmark for Indian companies to borrow from the international market. And sixth, if government of India issues a sovereign bond, it is under compulsion or it has to follow the fiscal responsibility. That is, in simple terms, the experts are saying once they issue the bonds in the foreign market, they are liable to follow the fiscal responsibility and budget management in the form of reducing revenue deficit, in the form of reducing fiscal deficit, in the form of increasing quality of expenditure, so on and so forth. So these are some of the very important benefits which are associated with the proposal of Government of India to issue Indian sovereign bonds. But having said so, there are a large number of concerns which have been raised by various experts with respect to this particular proposal. What are these concerns? First, various experts are saying, yes, by issuing these particular bonds in the foreign market, the dollar inflow into India will increase, foreign currencies or foreign exchange reserves will increase, but when the dollars will come into India, it will lead to rupee appreciation. I'll repeat the statement. When the dollar will flow into India, there will be supply for dollars in the forex market, demand for rupees will increase, rupee will start appreciating. And when rupee appreciates, the imports will become cheaper. And India already is a net importer. And on the other side, Government of India very recently in the concluded budget has announced tariffs or taxes on the imports. So on one side, because of inflow of dollars, rupee will appreciate, the imports will become much cheaper, the value of imports will suddenly increase. India is already a net importer, and upon this, Government of India wants to control the imports. That is one concern. Second, when the repayment will be done, what if there is a rupee depreciation? That is basically, let's say hypothetically, when Government of India borrowed in terms of dollars, the exchange rate was $1 is equal to 50. And when it is about to repay, the exchange rate is $1 is equal to 60. Now, don't you think when they borrowed $1, they bought or they got 50 rupees? And when they're supposed to repay $1, they're supposed to spend 60 rupees to buy $1. So this kind of a depreciation in rupee will have a huge impact on the earnings or the benefits that India can derive from these kind of Indian sovereign bonds. But having said so, understand this. Government of India very recently has stated that they will enter into concept of a hedging to overcome this particular rupee depreciation issue. Now, you need not be worried about the technical concept of hedging. In simple terms, remember this. Whenever these kind of trades are done, that is trade in currencies, there is an underlying risk. To overcome this underlying risk, the participants will enter into another agreement. I'll repeat the statement. These kind of transactions, there is an underlying risk. To overcome this particular potential risk in the future, the participants will enter into another agreement, which is basically nothing but a concept of a hedging. But more importantly, whenever you enter into hedging, again there are costs associated with this. That is the second issue. Third issue, what has been the international experience? This is not the first time that any country is issuing a sovereign bond. Many countries in the past have issued sovereign bonds. But the concern has been, when they issued, they earned these particular dollars or foreign currencies, but their currencies depreciated over a period of time. Hence, they had to undergo a huge problem to repay these particular borrowings. And in case of India, traditionally Indian rupee has depreciated against a dollar. That is a concern. Fourth, various experts are saying, what is so urgent, what is so devastating that Government of India has decided to borrow from the foreign market rather than from the domestic market? When we experienced a crisis in the year 1991, we did not borrow from the foreign market through the sovereign bonds. Post 2000, when we experienced a crisis, we did not borrow. Post 2010, we experienced a crisis, we did not borrow. So what kind of a crisis is developing in the domestic market that Government of India is forced to borrow from the foreign market rather than borrowing from the domestic market itself? And fifth, experts are basically saying that if Government of India wants to ensure the dollars will come into India, if that is the main objective, why doesn't Government of India increase the limit which it has imposed on FPI's investment in the debt market? Give more relaxations. Increase the limit. Obviously, automatically, all these particular dollars which you want to raise from the foreign market will start coming into the domestic market without Government of India going to the foreign market. Next concern. The former RBI governor, Mr. Raghuram Rajan, has basically argued that when these particular bonds are issued in the foreign market, certain investors who are not very serious investors might invest in these particular bonds simply because Indian economy is doing well. and they're expecting better returns. And as soon as the Indian economy falls into a problem or enters into a troubled phase, these particular investors will simply dump these particular bonds in the international market, which will not only affect the sentiment or investor sentiment in the international market, will also affect the Indian market. The statement that he used was, should we allow the foreign tail to wag the Indian dog? So these are some of the important concerns or issues which have been raised against this particular concept of a sovereign bond. So this is in brief related to this particular concept. Thank you. Have a good day.